You've heard of it, right? Passive investing. It's that simple, low-cost strategy that has totally taken over the world of finance. I mean, it promises a safer, more diversified way to grow your money. But what if its incredible success has actually created a hidden paradox? One that could be making the entire market a whole lot riskier. Let's get into it. This is a question that really cuts to the heart of how millions of us invest our money. For decades, the advice has been pretty clear. Just buy the market through an index fund. It's the smartest, safest move. But what happens when basically everyone starts doing the exact same thing? So to really get why passive investing became this huge deal, we've got to rewind the clock a little bit. There was a time when the average investor, someone like you or me, faced a pretty big dilemma. They really only had one main option, and it came with some serious baggage. And that option was called active management. Now, the promise was super tempting. Hire some Wall Street genius, an expert stock picker who would use their skills to outsmart the market and get you amazing returns. But the reality, well, it was often kind of disappointing. The fees were high, and they just eat away at your profits. Plus, study after study kept showing the same thing. Most of these expert managers couldn't even beat the basic market indexes they were trying so hard to outperform. So people got fed up. And out of all that frustration, a really simple but honestly revolutionary idea started to catch on. The thinking was, hey, if you can't beat the market, why not just own the market? And that, my friends, was the beginning of the passive revolution. Now, this didn't happen overnight. It started as this little niche idea back in the 70s, but the 90s, whoa, that's when things really took off with the creation of exchange-traded funds, or ETFs. That was a total game changer. Suddenly, it was incredibly easy for anyone to buy a tiny piece of an entire index. Fast forward to today, and thanks to super low fees and all of us piling money into our 401ks, passive investing isn't just popular, it's dominant. We're talking more than half of all the money in equity funds. And wow, this chart right here really just hammers the point home. Look at that. For the last 10 years, it's been a complete tsunami of cash. Trillions of dollars flowing out of those old active funds and pouring directly into passive ones. It's truly one of the biggest shakeups in the entire history of finance. But here's where the story takes a bit of a turn. Because with that kind of incredible success comes some, let's call them, unintended consequences. As passive investing has become the default for pretty much everyone, it's actually started to change how the market itself works, and it's introducing a whole new set of risks that, honestly, a lot of people just aren't aware of. All right, so what is the catch? What's the big deal if everyone just starts buying the same stocks through the same big index funds? Does it really matter? Well, yeah, it turns out it matters a lot. You see, this flood of money is what some people call price insensitive. That just means money is buying stocks simply because they're part of an index, not because anyone checked to see if the company is actually a good investment. And that creates some real risks. It leads to way more concentration in just a few giant stocks. It can actually reduce the benefits of diversification, and it can cause whole groups of stocks to move together in lockstep, which can really amplify market swings. Okay, let's zoom in on what is maybe the most shocking risk of all, this incredible concentration of power and money into just a tiny handful of companies. 33%. Just take a second and look at that number. What on earth could that possibly represent? Well, that is the absolutely staggering percentage of the entire S&P 500 index that's made up of just 7 companies, the ones they call the Magnificent Seven. Think about that. If you own a standard S&P 500 index fund, about a third of your investment is riding on the fate of just those few tech giants. I mean, is that really what you think of when you hear the words broad diversification? So how did we get here? This slide explains it perfectly. You see, most of the popular index funds like the S&P 500 are market cap weighted. All that means is the bigger a company gets, the bigger its slice of the pie. This creates a kind of snowball effect. As a company's stock goes up, its weight in the index goes up, which then forces all those passive funds to buy even more of it, pushing the price up further. Now compare that to an equal weighted index, where every single company gets the same tiny slice. The difference in concentration is it's night and day. And all of this leads to a really fierce debate happening right now among analysts. Is this new, super concentrated market just the new normal? Is it stable? Or is it a massive bubble just waiting to pop, all inflated by trillions of dollars flowing in on autopilot? This quote just nails the central dilemma. The very thing that made passive investing so attractive, its scale and simplicity, is now creating this powerful self-reinforcing cycle. More money flows in, it all gets crammed into the biggest stocks, their values go up, and that just attracts even more money. It's a feedback loop that has a lot of smart people pretty worried. And you can literally see the effect right here on this chart. This shows something called co-movement, which is just a fancy word for how much different stocks move together. That solid line, that's passively owned stocks. See how it keeps trending up? It means they're all starting to move in sync, not because their businesses are alike, but because they're all being bought and sold by the same giant funds. And that erodes diversification and could magnify a shock across the whole system. Which leaves us with this one final and kind of unsettling question. After all these trillions of dollars have flooded into the same handful of stocks, what happens if the tide turns? What happens if everyone tries to rush for the same very narrow exit door, all at the same time? And that, right there, is the heart of the passive investing paradox. A strategy that was built on the idea of safety in numbers might be creating a whole new kind of risk, precisely because of those numbers. It's a really important reminder that in the markets, there's no such thing as a free lunch. It's always a good idea to understand what's actually happening under the hood of your own investments. This is not financial advice.